There are two financial metrics that almost every business leader confuses constantly, and that mistake can cost them a lot. Gross margin and operating margin are not the same thing. They measure different things, they tell different stories, and making decisions based on only one of them is like driving with one eye closed. Today, you're going to understand the difference once and for all. Gross margin measures how much money you keep from each sale after subtracting only what it costs to produce or deliver that product or service. That's it. No rent, no marketing team salaries, no software subscriptions. If your company brings in $1 million and it costs you $600,000 to produce what you sell, your gross margin is 40%. You kept 40 cents of every dollar before paying for anything else. That number tells you whether your product makes economic sense, whether your pricing is right, whether your production process is efficient. But here's the mistake a lot of people make. Assuming that a high gross margin means the business is profitable. It doesn't.
Losing hours on data analysis? Scoop investigates for you and provides answers in 45 seconds. Don't know why revenue dropped? Scoop tests multiple hypotheses and finds the root cause in under a minute. Scoop Analytics is your AI data scientist.
Operating margin goes one step further. It takes your gross profit and subtracts all operating expenses: salaries, rent, marketing, technology, research and development, everything it costs to run the company. Following the same example, if your gross profit is $400,000 but you spend $300,000 running the business, your operating income is $100,000 and your operating margin is 10%. That's the real number. That's the true measure of how efficiently your entire organization is running. And unlike gross margin, operating margin is something you can directly influence. Every inefficient process, every redundant tool, every overstaffed department, all of it shows up here. The team celebrates. But if that same company is spending a fortune on sales and marketing without a proportional return, its operating margin could be sitting at 5% or less. Gross margin never caught it because those costs aren't in the cost of goods sold. Operating margin would have flagged it immediately. The lesson: you need both metrics, tracked consistently, not just when someone asks for them. So, which one matters more? Both. Always both. If you're in an early stage, gross margin is your North Star. Prove that your product has economic viability before you scale. If you're already growing or running a mature business, operating margin becomes your primary operational KPI. The question is no longer whether you can sell at a profit, it's whether you can build an efficient organization around that product. Together, these two metrics give you a complete picture of your business's financial health. Separately, they only tell you half the story.
Losing hours on data analysis? Scoop investigates for you and provides answers in 45 seconds. Don't know why revenue dropped? Scoop tests multiple hypotheses and finds the root cause in under a minute. Scoop Analytics is your AI data scientist.